And here we are again. Another week, another market.
Another month. May it is.
Oh, yeah. Happy birthday.
Yeah, thanks.
You're finally 30.
Pretty close. Wait, let me think. Yeah, I'm still closer to 30 than
Death.
something death, I guess. Maybe not, but you never know.
No. Let's stay positive.
Yeah.
What do you got? I mean, there's been a lot going on. I haven't even been able to keep up with the market this week because I've been making so many changes to our system, but I did look at it today.
Yeah, it's up a little bit today. It's one thing I'm going to talk about in the newsletter.
And when I say today, I mean Friday because it's Sunday when this comes out. So
yeah, Friday. Yeah,
I confuse people.
Yeah. The I'm going to talk about it in the newsletter. But if you look at a chart of the dollar, in 2022, the dollar was going up on a very consistent trend over time since the end of 21 through 2022. The dollar was going up and stocks were going down. It was a really good inverse correlation of the dollar up, stocks down. That was under those economic conditions. Since the beginning of the year, basically, the dollar has been down and stocks have been down. And so now the dollar is basically at a really long-term triple bottom. And it's hovering right around that level. It broke down quite a bit today, which is why the iFund is up right now a lot today. So if that bottom breaks out in the dollar, the iFund rips higher, and stocks go much lower. So what the dollar does at this point is really, really important. But there's just so much going on. I don't know how, if you're not looking at charts, how you can have any idea of how to make reallocation decisions.
Well, I mean, I think that just goes without saying. Honestly, unless you follow people like us, I don't even know why you'd be looking at the charts. I mean, that's the realization I came to. I don't know, at some point when we're doing this thing, is because if you don't know anything about this, you don't know what you don't know, right? You don't know that. Oh, if I take a look at these things, because I had never seen a technical analysis chart until I met you. I have seen charts on Bloomberg or Yahoo Finance, on the web, but those are just little snapshots, like just for looks, On most of those now I learned, not on Bloomberg, but wherever you find a chart, if you click on full chart or whatever, it will usually give you like what we're used to using, some version of it, right? It's so much more information. And so but you don't know any of that, and it's all gobbledygook anyway, right? But hopefully we're spreading the gospel, the good word, that it really isn't that hard to look at a simple chart. I mean, my brain doesn't work well with charts. It never has. I sucked at statistics for that reason. But even I can see it, right? And
that's the thing, you can see it.
You can see it. You don't have to have someone explain it to you or take someone's. Because this is what it really is, you never lived this life because you've always been looking at these charts, some version of this, right? Yeah. And so pre-charts or any of this technical analysis stuff, all you ever hear is somebody talking about such and such being up 3% or down 7%, or it's just something that they're repeating that they heard somewhere else, whether they read it or heard it or whatever. And you nod your head and you go, oh, yeah, the Dow's down 30 points. Oh, my gosh, I don't know what the heck that means. Yeah. That is the normal conversations with people that are not truly educated in the market. And it is a damn shame because you can easily teach this stuff in a semester course in high school.
Definitely.
Not technical analysis, but really just
the basics of understanding
basics, it. Yeah. Price action in the market. Like, dude, it's not that hard. And it's a shame. Not only do we not have it in high school, but you don't even have it in college unless you're a finance person. And even then, as far as I know, the finance people I've talked to, they don't look at these kind of charts. They don't get taught technical analysis, and it's not that hard. And here's our little soapbox, and you're listening to this, and tell your friends, listen, this stuff ain't that hard.
It's not, and it's the only way to keep from losing your mind, basically. Like right now, shipping, if you've been reading the news at all, shipping containers are not pulling in to LA. Like the tariffs are starting to have an effect. We're not seeing it yet, but apparently over the next few weeks to months, the shelves supposedly are going to be bare.
Well, yeah, I heard a great version of this yesterday. This is COVID again for different reasons.
Yeah, right.
Tariffs are going to do similar things that COVID did, meaning the supply chain is getting disrupted. And when you disrupt this supply chain even an inch, it's like a chain reaction that doesn't show up for a few days or weeks.
It won't show up in the numbers. That's the biggest thing.
Yeah, what you're going to do is there's some version of no toilet paper. Right? So there's some version of that's going to happen. You're going to walk into a grocery store or a store of some kind, and you're going to be like, why is that rack empty? Well, that container contained this particular item that now got tariffed, and they're like, we got to send it back, or I don't know what, right? Or it never gets there, or whatever it is, whatever the supply chain mechanism that finally kicks in with these tariffs. And then it's going to take a while to unwind it. That's the really part for me is if it was another, I forgot what we call it, pandemic. If it was another pandemic, we might be able to lay a template on it and say, okay, generally speaking, this is about how long it takes us to recover from a pandemic. We did it recently enough. When's the last time we recovered from tariffs?
1896, I think we talked about it.
There's no template.
Yeah.
There's no template you can overlay. There's no economist that can say, oh, I know the answer to this. Bull crap. It's not happening. You can't. There's no template you can lay on this and go, okay, well, historically, this is what's going to happen. It's not happening.
What they do is the template they're laying on right now is if inputs, what's it called? Imports drop significantly, which is apparently a known over the next couple of months. It's supposedly apparently fact, right?
Yeah, that's what tariffs are for.
Right. And it's anticipated, so it's not a fact yet. I mean, who knows? But it's as close to a fact as we're going to get right now. If you even before Christmas is going to be the big whammy, but before Christmas, as GDP goes down because all these imports are decreasing, we just had this week, they came out that the first quarter of GDP is negative 0.3%. So if we get if second quarter of this year is negative, you're officially in a recession. And everybody is anticipating this recession now because it's all but baked in. It's like known, right? The problem, of course, is when it's known, the market goes the other way. But presumably we get this recession, the economy, the numbers are already clearly getting worse. And yet the stock market's rallying.
But I'll throw my crystal ball up there because I feel like we're starting to see this more often than not. And we didn't used to see this, I feel like. And that's just a feeling. It doesn't mean anything, right? This isn't facts. But Conan's crystal ball is you look at it and you go, in the past, I don't want to say 6 years, 5 years, something, right? 2020, after pandemic. Sentiment has been such a fickle thing for a good while now. And so what I mean by that is, for whatever reason it is, we get optimism. Even when we see the train coming, we see the headlights coming, we're like, oh no, this is fine. Everything's fine. And we stay optimistic until we don't. And so we haven't felt, like we just said, we haven't felt the impact of these tariffs yet. We see it coming. Yep. They've told us what's happening. Yep. We know what's coming. And again, like you said, if it proves it to a certain extent in another quarter and we're in a recession, if we're not feeling that recession, we're still going to be optimistic. The moment we start to feel it again, I think things change, which would line up with some of the plan A, plan B kind of things you put out in the newsletter where it's like, if these things happen, here we can look for this. Yep. If these things happen, this is more likely a little up and a little, a nice little run, but then a collapse. Yep. Both of those make perfectly good sense. Yep. If we never feel the restriction, the recession, yep. If we never feel that crunch, and I mean feel it, I mean more than a week or two, right? Because that's what happened. Like when this all first happened, people were like, "Oh my, well, it hasn't happened yet."
That's the first leg down, right?
Yeah.
Now this recovery rally is optimism getting better. Yep.
Absolutely, and then there'll be a little greed in there, and then massive fear because I don't have toilet paper or whatever that,
Yeah.
I hope everybody remembers that, I'm using that analogy because I've never in my life period walked into a grocery store and saw any section of any grocery store completely empty with no hope of it refilling.
Yeah.
And it was toilet paper.
That was
We even
COVID.
have a sign in our bathroom that says, something like, remember when you couldn't find toilet paper? I don't know what it says, but it's just like remembering that because that was that weird thing during the pandemic.
Yeah.
And I'm sure there were other things, but that one really struck me because it's like toilet paper? Like,
Yeah.
what? Who? There might be a version of that. And it could be, I've heard, things like no 4th of July decorations. No.
Anything made in China, basically.
Everything made in China, because we don't make that stuff.
Yeah.
We don't make little USA flags.
No.
We don't do it. We make big ones,
Yeah.
right? I know some companies that still make the real ones, but those all that stuff, I've seen several party supply stores closed. The major chain, I can't remember what it's called, Party City, the one right here in Leesburg.
Yeah.
A lot of those. Why? Everything in that store is made in China.
Yep.
Everything. Every piece of plastic, paper, whatever the heck it is. Anyway, and a lot of people buy that stuff online anyway, so that has a lot to do with that. But it's going to impact a lot of that stuff to where you see like, why aren't there? I don't know. Pick a thing.
Yeah.
That one struck me though because I was like, you know what? You're right. By July, we might be feeling this, and all of that stuff is sitting over in warehouses in China, and normally it's on its way to be sold for 4th of July.
Yep.
And all these ribbons and flags and things that Americans do to decorate for that thing is all made in China, and we won't have it.
It takes time to get here.
I'm not saying we need it.
Yeah,
So
no, but
I'm not going to be torn up if I don't have any decorations.
it takes time. Well, I mean, as a side note, fortunately, the things that we care about are made in Tennessee. So,
True. Or Kentucky.
Kentucky, yeah. There's a lag time, and so all these shipment containers that are expecting to fill shelves for Christmas, June, July is like when that happens. So if this stuff doesn't get resolved, it's going to be a rough Christmas, and that's the majority of gains for a lot of retail is Christmas holidays. So it doesn't turn on and off on a dime. The economy anyway. The market might change, but all right, we're going to get into actually quite a bit of these things as we roll forward with this. So what happened this week? Then big tech earnings. That was the thing that really propelled the market this week was a big tech earnings. We'll look at that a little bit. And then what Conan was talking about, we put out this week. They're basically, the economy, market versus the economy. We'll talk about that. V-bottom or expanded flat is what he was talking about. Basically, two possibilities going forward, and then the TSP fund charts. So Monday we get the Dallas Fed Manufacturing Index. So manufacturing and services are the two parts of the economy. If you divided it in half, those are the two pieces. The manufacturing index plunged 19.5% to negative 35.8 in April, its lowest level since May of 2020. S&P was basically flat. It was up 0.04% for the day. But the Dallas Fed, so at the website, Dallas Fed's General Business Activity Index for Texas, Texas manufacturing plunged 18.5 points to minus 35.8 in April, reaching its lowest level since May 2020 and signaling a further worsening of sector conditions. The production index ticked down 0.9 of a point to 5.1, while new orders index plummeted 19.9 points to negative 20. The shipments index fell 11.6 points into negative territory at negative 5.5, and the capacity utilization index slipped 1.5 to minus 3.8. So what does all this stuff mean? This is the zero line. There's manufacturing and there's services. This is the manufacturing chart. If it's below 20 or below zero, you're in a recession. The manufacturing sector is in a recession. This is why everybody was talking about recession in 22 and 23, and it never happened because the services side of it was above the zero line. But manufacturing has plummeted, right? I mean, it's not good. It's really, really not good. So manufacturing is definitely in a serious hole. I mean, this is the bottom from COVID. That's when nothing was happening in the world. And so we're, pretty close to back where we were in 2016. It is not good. And it leads, right? This was the peak in manufacturing in early 2021, and it started rolling over. When did the S&P actually roll over? It wasn't until the beginning of 2022. So could we be in this rollover of manufacturing, right, that started back here at the end of 24, and here's where the S&P starts really rolling over, right? We'll see, but it's not looking good. It's not looking good for the economy. Tuesday we had good balance, good trade balance. Okay, so fell to minus 162 billion versus 140 billion forecast. So what that means is we had a negative trade balance. So we are importing way more than we're exporting. Okay, the projection was for 140 billion trade difference. We got 162 billion. It was the biggest on record. What that means is companies are front-loading imports in advance of the tariffs. So the reason the shelves are full right now is because companies are bringing as much stuff in now before the tariffs kick in. And so it looks like everything's fine. I mean, it looks like everything's fine and it's going to drop off the cliff as soon as the tariffs really kick in and stuff stops being shipped. It's going to drop off like a cliff, but you don't see it right now. So unless you're listening to this or listening to other people talking about it, you don't see it in your day-to-day life. And on Wednesday, mortgage rates basically stayed the same. They dropped to 6.89% from 6.9 last week. New applications dropped again, 4.2%. They were down 12.7% last week. This is an interesting one. ADP employment report. So ADP is a private company, and it gives you actual data as opposed to the Bureau of Labor and Statistics, which gives you like survey data. ADP is, there's a couple of ADPs, right? There's a couple versions of ADP, but ADP is the big one. And, if you have a company, you're running your payroll and everything through ADP. And so the reports that they put out are much more accurate in what's actually happening than the Bureau of Labor and Statistics. And so the ADP report comes out, private companies, so not government, but private companies only added 62,000 workers in April versus 115,000 forecast. And they added 147,000 in March. So private companies aren't hiring, right? It's way down. Initial jobless claims were at 241,000 versus 223,000 last week. So not too much of a big uptick there. Continuing claims are up a little bit, but not that much. S&P's up, 0.63%. And then on Friday we get non-farm payrolls, which is contradictory, but according to the Bureau of Labor and Statistics, we had 177,000 new jobs added, right? Way above the expected 130,000 that were expected. So that number is telling you that more people are getting hired, right? It's definitely in conflict with the ADP number. And we know the difference isn't hiring new government employees. That's not happening. So I don't know. But unemployment stays the same at 4.2%. So that was actually good news for the market, and that's one of the reasons that the market's rallying on Friday. The other big reason is big tech earnings this week. So this is the most interesting one we're going to talk about a little bit. Last week, Tesla reported earnings. Tesla was down, the stock was down over 50% since the beginning of the year. First quarter earnings come in, they had a net income decline of 71%. Their net income declined 71% in the first quarter. I mean, that's ridiculous. And then over the next 5 days, it rallies 20%. How can your stock's down 50%, your net income for the quarter is down 71%. You report those earnings. Obviously, it was a huge mess, and you rally 20% over the next couple of days. Maybe all the bad news is priced in, and analysts said, well, it can't possibly get any worse than this, so the stock's going to have to go up from here. They're always going to come up with a reason why, but that one's kind of unbelievable. But it was pretty good, because if you're looking at it going, okay, if the market rallies on that kind of news from Tesla, what's going to happen when Microsoft, Google, Meta, Apple, and Amazon report this week, right? So Microsoft beats earnings, revenue's way up, net income's way up, rallies 8% that day. Google beats earnings, revenue's up, net income's up, rallies 1.13. Meta beats, rallies over 4%. Apple and Amazon reported on Thursday, and so we'll see what happens on Friday with them. But they were both up. The interesting thing about Apple and Amazon, though, is the China problem hits them really, really hard. So we'll see. The Nasdaq is up as of 11 in the morning on Friday, but we'll see how that turns out. And then the other big news this week, like we said, first quarter GDP was negative 0.3%. So 2 consecutive quarters of negative GDP growth is the definition of a recession. All right, so market versus the economy. You get the same data, right? Analysts are looking at the same data, whether you're an economist or an analyst. If you're a market analyst or you're an economist, you're looking at the same stuff, but the market interprets it for different reasons than an economist does. And the market theoretically leads the economy by 6 months, is what they say. So the current economic data is telling us what's actually happening right now. The market takes what's happening right now and extrapolates it into the future to try to figure out it's the future value of money. They're trying to figure out what kind of rate of return you can get that this company will generate in the future, not right now. And us as retail investors cannot connect those dots. We have no way to do it. There's always going to be a reason, right? And Tesla's a great example. It was a huge, huge miss, and yet it rallied 20% in the next couple of days. So there's always going to be a reason, they're going to say, and you're never going to know what it is. So the only thing we can do is follow price. This is what Tesla looked like, right? It peaked in late last year, was down 56% to its low in March. You had a bottom here, a retest, a retest, a retest, and that was the earnings day. Okay. It had support there. If you're looking at it from a technical analysis perspective, you have all this support there. Can price break that line and go lower? Yes, it could. But that is a great buying opportunity, right? Going into earnings. And then what happened? It gapped up. I mean, it's really hard to do that because everybody knew that Tesla was in big trouble and tanking. So there's no reason emotionally or intuitively that you would think that Tesla was going to rally. But if you're looking at it purely from a technical analysis perspective, you have a whole lot of support at that 220 level, and it just took off. So I don't know how you do it if you're not following a chart. Okay, so what do we get possibly going forward in 2025? This is what COVID looked like. So obviously we're not in a pandemic, but like Conan said, it's something very similar, right? This was the peak before COVID. We had an A, B, C, right? A 3-wave down. 1, 2, 3. Meaning we had our first leg down, then we had some optimism, then everything completely collapsed into the bottom, straight down, in 3 waves. Then we had an A, B, C recovery out of that. Once we got above this high, right? We had a recovery rally, we had a pullback, and then the rally continued. Once we got above this high, that was a reasonable time to get back into the market. Okay? And then what happened from COVID is it was what we call a V bottom. It hit that bottom and basically never looked back. And we had consistent lower highs all the way along, right? That's what happened after COVID. And it took about 6 months to the day to get back to the prior highs. This is what it looks like in 2025. You get a peak in February 19th. You had your first leg down. You had a little recovery rally, optimism, and then a big flush out to the bottom. We had that bottom in early April. We had a rally, a pullback. The rally continues, and we broke the neckline. This is basically where we are. This was, Wednesday or Thursday this week, right? So it's very, very similar to what it looked like in COVID, at the breakout right there. That's where we are right now. So if you think the market's going higher and we're going to get a V-bottom, which is one of those possibilities, and we're going to be back up here to new all-time highs, it seems inconceivable with all the recession possibilities and everything else going on. But if you remember, in March of 2020, it was the beginning of COVID. It wasn't the end. It was people were just, the stores were just starting to clear out. Like that was the beginning of COVID, but it was the end of it from the market's perspective. So could that same thing happen now? Could this have been the whole drawdown from tariffs? Absolutely, it's possible. And the market just keeps on going. That's a possibility. Seems inconceivable, but it is definitely a possibility. What if that doesn't happen? The next most likely possibility is what they call an expanded flat pattern. The good thing about an expanded flat pattern is it's a consolidation, which means once the pattern completes, it starts going higher. Okay. So we came down, just like in COVID, in an A, B, C, right? For the first wave down for A. We're in the middle of this ABC recovery right now, right? If you read the newsletter, there's all kinds of analysis that you can do to try to figure out where point B is going to be if we get there and it rolls over. But at some point, if we get an ABC to give us that point B and the market rolls over, the expanded flat pattern is 3, 3, 5. 1, 2, 3, 1, 2, 3, 1, 2, 3, 4, 5. Okay, that's the textbook definition of a flat pattern, expanded flat. If we get somewhere down here around the same level as we were in April, maybe a little bit lower, that's also where the 200-week moving average line is right like that. That would be an unbelievable buying opportunity if we got down there. But this would be awful painful. And if you don't understand what it is, you think the world is ending and we keep going down. But that won't be the case. It'll be a great place to buy. So we will track it, and you definitely want to subscribe and read the newsletter because it gets into a whole lot of detail every week. Okay, TSP fund charts. So this is the weekly chart of the C fund, and again, this is the charts that we use. We build them in stock charts. So these are the actual numbers of the TSP fund. Okay. The dividends are reinvested in TSP. They're not reinvested if you're looking at a chart of the SPX, the actual S&P 500 index. So the charts look a little bit different because of the dividends being reinvested. So you got each one of these ticks is 1 week of price movement. This is the 20-week moving average and the relative strength indicator. As long as price is above that 20-week moving average line, price is going higher, right? When it's below the 20-week, you don't want to be in the stock funds. And we've been down here now for a couple of months. We've obviously rallied off the bottom, but we're still not back above that 20-week moving average line. The closest, most recent example, we came up and rallied to it in March right there, hit it and rolled right back over. So could we come up, hit that line, and roll right back over? Absolutely. And that would be your 1, 2, 3, 1, 2, 3, 1, 2, 3, 4, 5. That's what it would look like. The other thing is until we get above that 50 in relative strength, this is even an easier chart to easier kind of to see. If you're below 50, and it's not an exact science, right? But if you're below that 50 line, stocks are going down. If you're above that 50 line, stocks are going up. S fund, it's fallen like a rock, right? And unfortunately for the S fund, it's not a 3-3-5. It's a 1, 2, 3, 4, 5, which implies that you get a 1, 2, 3, and then another 1, 2, 3, 4, 5 down. The S fund does not look good from a technical analysis perspective. We're back well below the highs from 2021, and relative strength, hit 30, and that's what gave us this bounce. I would be amazed to see relative strength get above 50 on the S fund on this rally. I fund has the most potential going forward. Basically, like I said in the beginning, the dollar is falling. If the dollar continues to fall and breaks through a really important support level that it's at right now, the I fund just takes off. This has been almost a 20% increase since this low, and so it would be great to see some kind of pullback, a retest of that 20-week moving average line as a place to get in. But the I fund is pretty strong right now, much stronger than the C or the S funds, and if the dollar continues to fall because of tariffs, the I fund's just going to rip higher. And F fund is just going nowhere. These 2 weeks are really interesting right here because we had a breakout, we had a complete flush out to the downside, and it looks like the trend is just continuing. But the Fed's in a tough place, and so as rates come down, the F fund goes up. If rates go up, the F fund goes down. Strange times, and of course the G fund always goes up and to the right. The only downside of the G fund is if rates go down, your rate of return on the G fund goes down, but your principal is never going anywhere.
But it won't go negative.
Can't go negative. Questions?
Well, we all wish we had a G fund. Questions? If you got any questions, send them to us. We love to ask. We love for people to ask questions so we can answer them. We love to talk about stuff on the show. So put a question in any comment section you find wherever you find the video. And if there is no comment section, you can always shoot us an email at support@growmytsp.com. And if you like it, share it with your friends. And if you don't, share it anyway. All right, guys, we'll see you next week. We're out.
Out of here.